So China's Treasury holdings peaked in something like 2013 or 2014. They've gone steadily down. They even announced it at the time and basically said it's no longer in our interest to keep accumulating these. They started to instead invest more into like Belt and Road Initiative type stuff, marginally increase their gold holdings. Some people have reasonable speculation that their gold holdings are higher than they stated, but that a lot of that just could be private sector buying. Either way, there's a lot of gold in China. Basically, I think that they're going to hold a lot of assets aside from treasuries. I don't, not that the treasury is necessarily going to go to zero, but that they just don't want this big, gigantic kind of unilateral exposure to, um, the U.S. government. Um, I think they're gonna redeploy that elsewhere broadly. Um, I've had the view that kind of gold is gradually reasserting itself into the global reserves like system over time. Technically, that bottomed in like 2009. Like if you look at central bank gold tonnage, it was on this like multi-decade decline until like 2009, and then it kind of started like a V and started going back up again.
Gold
It
tonnage
obviously
as a percentage of total assets.
it's raw gold tonnage.
Okay.
Yeah, raw gold tonnage, and as a percentage of assets, it's kind of chopping sideways to up. I think we've seen the bottom both in tonnage and in terms of percentage of assets. Um, and I think that there's just more interest in holding gold around the margins. I do think you'll still see some treasury purchases by foreign sectors, but the question is how much do they own?
China's U.S. Treasury holdings have been steadily declining since their peak in 2013, and they've made it clear it's no longer in their interest to accumulate these assets. Instead, they're investing in initiatives like the Belt and Road and boosting their gold reserves, with speculation suggesting their holdings could be even higher than reported. This trend signals a shift that could have massive implications for the U.S. economy. As foreign ownership of treasuries continues to drop, the burden increasingly falls on domestic banks and the Federal Reserve to step in. But what happens when the liquidity levers run out? Stick around as we dive into what this means for U.S. financial stability and what could be next.
Like if you look at foreign holdings as a percentage of Treasury securities outstanding, that's been on a pretty significant decline for years. I think that probably stays, roughly where it's at, or maybe continues to go down a little bit. Um, for who buys it, I think it'll depend on the time frame. I think partially it'll be bought by domestic non-bank investors, partially by international investors, just not in super high amounts. We've already seen banks go back to buying treasuries. So for like a 2-year period, their treasury books were shrinking. They're back to buying now. And there is all, if they run into liquidity issues in the treasury market, they have levers they can pull to change regulations to make it easier for banks to buy more. Um, by roughly late 2025, perhaps, I think we'll go back to mild Fed balance sheet increases of treasuries. If you look at they had a 2023 annual report that was published in early 2024, and they had these long-term balance sheet projections. And they basically projected that roughly in 2025, they'll kind of hit their floor, and then they'll increase their balance sheet in line with GDP so that they stay at a fairly static percentage of GDP. And specifically, they want to keep trimming off their mortgage book while going back to treasury accumulation. So I think that basically there's going to be multiple buyers. I think, depending on what time frame you have central bank, you have commercial banks, you'll have some non-banks, domestic, and then you'll have some foreign. And wherever there's a deficiency, it's basically the banks and the central bank that kind of step in if you have any sort of liquidity issue or, kind of dislocation in yields. Um, they can just kind of switch around whatever level is their pain point. They can switch the levers around. I think it'll probably not do well in real terms. Like earlier in this discussion, I pointed out that long bonds are not particularly attractive to me under 4% yields when we're running structural deficits this big, and in a world where probably we go back to some degree of monetization in the next year or two. Um, but I don't, if they start to get a situation like, for example, what the UK went through in 2022, the gilt crisis, they basically went back to temporary QE, put out the fire, and then kind of carried on. Now because they have a parliamentary system, they had more political repercussions from that. I think the U.S. The pain point is higher. Basically, if you get like serious dislocations in the treasury market, some sort of a liquid event, um, they reliquify it. So for the past couple years, one of the biggest sources have been reverse repos. Money's kind of, and that's like basically money markets are kind of just changing the composition from reverse repos to things like T-bills over time. We've had, there was that paper on activist treasury
Mm-hmm.
issuance, basically the purposeful issuance of more T-bills. That's something I haven't used that term, but I've been kind of pointing to that kind of the Treasury's been somewhat offsetting the Fed because there's different liquidity levers to pull. Um, and I think that eventually, when we run out of like reverse repos, and they basically run into the floor of bank reserves, they'll basically the Fed will go back to gradual balance sheet increases, and they're not going to call it QE, but they're going to call it just maintaining ample reserves in the system. They can do SLR adjustments if they really want to. There's political opposition, but that's a tool that they have. Um, and I think basically it's you get some degree of mild financial repression, which is that you make it easy to hold treasuries. You have all these facilities that give you plenty of liquidity when you need to swap back and forth to other assets. You weight things toward like just making it just, like prioritize holding treasuries, and entities that kind of hold them on leverage do okay. But if you're just like a consumer investor, if you're sitting there holding treasuries, I think you're gonna get like devalued over time compared to a lot of other assets that you could be holding. Yeah, I think you could have many crises. I mean, we had some mini crises. Like when we had a interview like a year ago, we were talking about like bond dislocations, and I had been concerned around that. Um, I think you punctuate between nominal losses and real losses, depending on whichever one they perceive as being less painful at the time. When inflation's running really hot, they're more likely to let nominal losses pile up to a certain degree. And if inflation's down, they're maybe more likely to gear a little bit more toward liquidity and inflation. And so I think that this is like the meme I use is nothing stops this train. I think this is a long-term story. It's not like something that, like when people ask when did America have a debt crisis, it's like this whole period. We're basically holding anything other than bonds was better than bonds. It's like if you had to point to a day where bonds are a problem. There were a couple major spikes on the move index, and like yield dislocations. Like September of 2022, for example, was kind of a mini bond crisis, and it's hit the gilt market harder. Um, I think you kind of have mini crises, and that they shift then to whatever's the release valve, and then that builds up, and you kind of shift back in another direction. So I think it's a slow motion boiling of the frog for for entities that are holding treasuries for years and years at a time. I think the equivalent is that developed market currencies, like including the dollar, get more emerging market like characteristics, right? So I think that we basically have higher background inflation offset by whatever productivity gains we get in AI and things like that. And if you get a ton of productivity and you get monetize fiscal deficits, then it's good for asset prices instead. So instead of it either goes toward consumer prices if you have bottlenecks in energy or manufacturing or services employment, things like that. If you don't get bottlenecks there, it piles into generally financial assets, Bitcoin, gold, high quality stocks, high quality real estate. It piles into those types of things. And so at the end of the day, these long-term bondholders, I think, are going to keep just like their purchasing power is not going to appreciate compared to most other assets you could hold. Now, that doesn't mean that there can be really good trades. If you do get like an unemployment spike from 4.2 to 5.2 over a given period, maybe bonds do really well in that 6 or 12 months. Like it's a tradable asset. But I think that basically anyone who just finds themselves holding them for 5, 10 years is going to continue to find other things running away from them. Um, we've already had a long period of that, but I don't really see a strong sign that that's over per se.
Now that you understand how China's shift away from US Treasuries could impact the economy, you'll definitely want to catch the next video on this channel. It's all about the next critical move in the financial markets and how it could affect your investments. Don't miss it.